Okay, we are moving on a little bit to some initial transactions that are related to the balance sheet. So we're going to be talking about some really important stuff today. And if you don't understand once you've listened to this lecture, then just play it again, go again and say, hey, let me see if I can get this straight. So this is definitely not something you want to say, oh, well, it doesn't matter, because this is background that's going to be built on for the entire course. Okay. So the first thing we'll talk about is, what is a T account? A T account is just a way we have of tracking the different activity of an account and we have a T account for every kind of asset and liability and equity account that we have. So for example, for the cash account, when I say cash account, I'm talking about your bank account usually. So when we talk about cash dollars, like $100 bills, we would probably have that in a petty cash fund, because when we say the cash account, we're actually talking about your checking account normally. And so this cash T account would record every transaction that we had. So if we had, let's just say we deposited $1,000 in the bank, we would record that $1,000 as going into the bank. And I'll tell you some more specifics about this statement in a minute. And then when we wrote a check for $200, we would record that in the T account. So then if that was the only two transactions we had, when we were come through with that period of time, we would tally up what our balance is in that account. And we say, oh, we have $800, just like a normal cash register that you would track your balance of something. So you'd have a lot of entries under the cash deposits and under the cash, the payments that went out from the account. Okay, so, but this happens to be a cash account, and that's why I put these things on the side that I did. But well, I want you to understand something generally about T accounts. It's not, you need to think of it as each side of it as being called the debit side and the credit side. The left side of the T account is the debit side. This side is the debit side. This side is the credit side. Oh, but you have to spell credit correctly. Sometimes it could be abbreviated, DR for debit, CR for credit. Oh, look, I get rid of some of this space here. Okay. All right. So the left side of the T account is always the debit side. Doesn't matter what account it is. If you say you're debiting the account, then that's you're actually making an entry on the left side if you're debiting. If you're looking at that T account, the left side is the debit side, the right side is the credit side. So if you could use the term debit to mean there is a debit in the account. Like when I put the $1,000 in the T account for cash, that was $1,000 debit to the account cash. And that $200 was a $200 credit to the cash account. And then when you looked at that $800 I had in there, that was the $800 debit balance in the cash account. So the term debit or credit can be a noun, meaning that is a debit in the account, this $1,000, or it can be a verb, which means I'm going to debit the account by $1,000. Okay, so all we've done here is just establish that there's a debit side and a credit side. Okay, it's trying to be freaky on me, but there we go. I'm gonna get these amounts out. Okay, don't try to put a negative and a positive on it, because I just showed you the cash account and how to record transactions. So for the cash account, a debit is a positive thing because it means you deposited money into your bank account. But it's not a debit, and credit themselves do not have a negative and a positive, because every time you make a journal entry, because of the fact that we're dealing with the accounting equation, and every asset entry has to have a corresponding liability and equity section. Some of them are debits and some are credits. Generally, assets are debit balance accounts, and generally liabilities and equity accounts are credit accounts. Now, there are exceptions because some things are equity accounts, but they reduce equity. So, and some things are asset accounts, but they reduce asset. And so, as a rule, though, asset accounts are debit balance accounts as a generality. And as a generality, the other side of the accounting equation has credit balance accounts. So I'm going to show you some of this stuff in just a moment on my spreadsheet I built. Let's go ahead and go to these examples. I talked to you a little bit about assets, liabilities, and equity in the previous lecture, but basically reminding you assets are resources the company uses. And so they're things that the company owns, that they've invested in, they can use to make money in the future. And so some of the examples would be cash, accounts receivable, supplies, equipment, land, and then another one we haven't mentioned yet, but prepaid insurance is an asset account. Inventory is an asset account. There's a lot of different asset accounts. These all increase with a debit. And then liabilities, the amounts that we owe to others or the owe to creditors would be things like accounts payable, the notes payable, and then we mentioned earlier an unearned revenue account would be a liability. So those would all be increased with a credit, which means their normal balance is a credit. So however you increase an account is their normal balance. Equity is the amount that's due to owners, and that would be like capital or common stock and retained earnings. Those increase with a credit. Also, things that affect equity would be dividends, where you pay equity out to your owners, and net income. So the revenue and the expenses affect equity. So what we're going to do is try to get straight in our head what the normal balance of accounts is. And that just means when you increase them, how do you record it? And so that's this little chart is this little format that I built. Assets increase with a debit. Now there's going to be a few cases where we have what's called a contra asset. And a contra by its very nature goes the opposite direction. So if you have a contra asset, it's not going to increase with a debit, it's going to increase with credit. But assets that are not contra would all increase with a debit. And that means that's their normal balance. Okay, and then liabilities would increase with a credit. So amounts you owe, when you record those, you show them as a credit in their T account and in their journal entry that's then posted to the T accounts. We get to all this later, don't worry. And then equity, all things under equity. You see this long line? All these accounts are included as part of equity. So contributed capital increases equity. And so it is recorded in increase, it's recorded as a credit, and that's its normal balance. Revenues also increase with a credit, and that's its normal balance. Retained earnings is talking about earnings, net profits increases with a credit. But the two that when you increase them, it's a debit, are expenses and dividends. And there's a reason for this. The reason expenses and dividends increase with a debit is that they actually reduce equity. So in a way, you could think of them as contra equity accounts. So that's why they don't go according to the norm for equity, which is the credit. They are contra to that because expenses reduce your revenues, don't they? And therefore reduce your equity. And dividends reduce your retained earnings. They're just part of the earnings that you did not retain and you paid out to your owners. So what we get from all that is we can see that the normal balances, if you learn the normal balance for three types of accounts, you kind of know where all the others are the opposite. The three types of accounts, assets, dividends, and expenses, all increase with a debit. And all the other accounts basically increase with a credit. So the only exception would be if the account is what's considered a contra. So in other words, a reduction account. If it reduces an asset, like if you have equipment and you're running depreciation on them, you will have an account called accumulated depreciation. That accumulated depreciation is a contra asset account. So it reduces the asset. But if normally assets, as by and large, increase with a debit. And so do expenses always, and so does dividends always increase with a debit. So this is a good thing to remember. I have it in alphabetical order, so you can use this little acronym if you wanted, ADE. That's just assets, dividends, expenses, and that's the accounts that increase with a debit. And that's the normal debit balance accounts. Okay, cash increases or debits. It's not the same as what you think of when you look at your bank statement. That's because the bank statement is not stating it for the customer's benefit. They are calling credits. The credits they are naming credits are from their accounting perspective, not their customers. So to the customer, a credit that when the bank says they give you a credit, they're putting money in your account. So that means to that customer that they're going to record that as a debit. So the best thing to do, rather than thinking of how the bank calls it a debit or a credit, is the best thing to do is to ignore the bank's definition of debit and credit, because we already know they are only talking from their own perspective. So we can't use that when we're making our accounting journal entries to record activities in the books. So the best thing to do, rather than thinking of how the bank calls it and reversing it, is we're just going to think of the underlying transaction and say, is this increasing my bank balance? If it is, then I'm going to record it with a debit, because cash increases, checking account increases are recorded with a debit. Okay, liabilities, as we mentioned earlier, are going to say payable, unearned, or due, and they increase with a credit. So getting this little chart very clear in your mind can help you so much when you're learning how to do journal entries. We're going to do a bunch of journal entries today. Okay, so let's go ahead and do some of these exercises. Again, I pulled these from the open source resource at Openstax, and these are also from chapter 3, just like last time. And there's a link to it at the bottom of my notes, but you don't actually need that link. I've got the whole problem right here. What we're going to do is we're going to try to figure out what is the impact of these following transactions on the accounting equation: assets, liabilities, and equity. The first one says, we received cash from issuance of common stock. So we increased cash. So it's an addition to cash. That's the first impact. I'm just going to go ahead and show them both. And we increased equity because we issued common stock. So we're just trying to peg it as one of three things: either an asset, a liability, or an equity entry. And so we increased cash, so we know it's an addition to assets. We increased common stock, so that's an addition to equity. Then the next one, sold goods to customers on account. In this one, we didn't get the money yet, but the customer owes us, and we got something called an accounts receivable. So we increased assets, and we sold goods, meaning we increased our equity because we had revenue from that. If we sold goods, that means we have revenue. That is an increase in equity. All right, then we collected cash. When you see the word collected, you always know it's an increase in cash. That's one of the impacts, is an asset increase. Has to be if you see the word collected. Collected cash means the cash account or the checking account, if you want to think of it that way, increased. And so then we look at, see, where we get it from. We collected cash from customer sales made in a previous month. So that means it's not another sale right now. It's a collection on our accounts receivable. So we increased assets by the cash, and we decreased the accounts receivable asset. So we did both to the assets, increased and decreased. But see, if you don't make a change in the assets, you don't have to make a change on the claim side. The resource side, the assets, is one side, and then the liabilities and equity is the claim side. And so if you change the asset side, you have to change the liability and equity side. But in this case, we didn't have a change in the asset side because we had an asset addition and a subtraction. So we increased and decreased the two different assets, but they're both in the assets section. So there was no impact on the claim side. Okay, so the next one, paid cash. And anytime you see paid cash, you know that cash went out. So I already know that this is going to be asset decrease. I don't want to change it to red though. Oh, there we go. Paid cash to vendors for supplies delivered last month. So that's talking about we owe our vendors, that's accounts payable. So we paid something we owed them. That means we decreased the liability. When you buy something on credit, you record the asset and you debit the asset, you credit the liability accounts payable. And so in this case, we're paying off some of those purchases we made last month. Okay, then the last one, purchased inventory on account. We're increasing an asset, and then we're going to increase the accounts payable. So we're going to increase an asset and increase a liability. Okay. Now the next one, identify whether each of these would be recorded with a debit or a credit. A cash increase. Okay, so a cash increase would be a debit because a normal balance for cash is a debit. Let's look at only the increased ones first. Accounts payable is an increase. So we would increase accounts payable with a credit because liabilities, normal balance is a credit, and that's how they increase. Now, all the rest of these are decreases. If I know that the normal balance or the increase side of supplies, the asset account, is a debit because it's an asset, then that means if I decrease, I'm crediting the account. So the normal balance here on this one is a debit. So if I am decreasing it, then I'm going to be crediting it. And this one, common stock is decreasing. What is a normal balance of common stock? Credit, right? But it's decreasing. So I'm going to debit it. Well, maybe, there you go. Same thing with interest payable. Interest payable is a normal credit balance. So whenever I decrease it, I'm going the opposite direction. Debit. Same thing with notes payable. Normal balance for notes payable is a credit. So if I'm decreasing it, I have to debit the account. So this stuff, again, just like I told you last time, you work with it and you just pace yourself and you say, okay, I'm trying to understand this. That doesn't make sense yet, but I'm going to do it. And it will start clicking. Okay, now this one. Identify the financial statement on which each of the following account categories would appear. Balance sheet, income statement, and retained earnings statement. And then also say what the normal balance is. So the financial statement, assets. What I would suggest is pause this a second. You fill it in and then come back and see if you're right. The financial statement for assets. It's a balance sheet, isn't it? Let's go all the way down here. The balance sheet's also the financial statement for common stock, isn't it? Does dividends show up on the balance sheet? No. It shows up on the retained earnings statement. Expenses, that's on the income statement. Liabilities, balance sheet. What's on the balance sheet? Everything that's in the accounting equation. Assets, liabilities, and equity. Revenue, what statement? Income statement. And what is the normal balance for assets? Debit. For common stock, oh, I'm sorry. And for common stock would be a credit. Oh, there we are. I was wondering why it wouldn't show up. Dividends, normal balance. Remember, ADE, asset, dividend, expenses. Normal balance is a debit. Expenses, normal balance is a debit. I don't know why they don't want to be nice to me. I'm trying. Liabilities, normal balance is a credit. Normal balance for revenue, credit. And revenue was on the income statement. For some reason, it didn't want to cooperate when I tried to mark it, but it's there now. Okay. Now, the next thing, the impact. These exercises are showing impact of plus for an increase, a minus for a decrease, and we're just going to use the first letter of the assets, A, liabilities, L, equity, E. Okay, if you issue common stock for cash, that means the cash increased, so assets increased. Common stock increased, so liabilities increased. I'm sorry, not liabilities, equity. We purchased supplies on count. That means assets increased and liabilities increased, because on account means it's an accounts payable. Then we paid employee salaries. You paid somebody, that means your cash went down. Again, this one, we paid somebody, paid the note payment. Assets went down every time you see the word paid. So if we paid employee salaries, that means we had an expense. So equity went down. We paid a note payable. That means the liabilities went down in that case. And then we collected the balance on accounts receivable. If we collected, that means cash increased, means assets increased. And we collected the balance on accounts receivable. So assets also decreased. Okay. And again, you can do these later. The worksheets, these note sheets are posted to Moodle, so you can just do those exercises and then check them by these videos. All right, this one. Identify the financial statements on which each of the following account categories would appear. So it's the same thing. The financial statements and the normal balance. So I would suggest that you pause it and correct it, and I'm just going to reveal those answers so that you can see what they are and talk you through it. So you see the accounts receivable, the cash, and the equipment are all balance sheet accounts. They're assets. So they would all say balance sheet, receivables, cash, and equipment. And they all increase with the debit. So the normal balance is a debit. Expenses, so that was the assets. I went through and picked out the assets that's because I knew those were debits and they would go on the balance sheet. Now I'm gonna go and look for expenses, and I'm gonna put them on the income statement with the debit balance for the normal. So there's the automobile expense. Expenses almost always say expense. A few exceptions are the ones that say cost. Some say cost of goods sold, but mostly in the things we're working with now, it's going to say the word expense, and that goes on the income statement, and it's a debit balance normal. So that takes care of all these that are assets and expenses. The other two are credit balance accounts, because the first one, note payable, goes on the balance sheet. It's a liability. And then the last one, service revenue, is an equity account. Well, it's a revenue account that affects equity. Let's put it that way. So credit balance, it increases equity. Ledger is a term. It says a couple of terminologies, set of exercises. Ledger is a term that is just a collection of T accounts. So if you had all these different accounts we've been talking about, they would each have a T account that would track all the activity that happened in that account. So if you put them all together, you have the company's ledger, and it just includes all the T account or all the account balances for all their activity that's happened. A compound journal entry, we're going to be making some journal entries, has more than 2 lines. A journal entry is just anything that's 2 lines or more that's going to have a debit entry, an account name with an amount for a debit, and an account name and an amount for a credit. I'll show you plenty of those, don't worry. Whenever you enter the debits, you always put those first, and you put them flush with the left margin, and then you indent a little bit in order to do the credit entry when you do it. So the credit entry name is indented slightly from the debit entry, and the credit entry amount is indented slightly from the debit entry. Then here's a concept that we are adding this time, the cost concept. We use historical cost, the amount paid for the asset, rather than changing the valuation on most assets. There's a few cases where we have to adjust the value to current values, but it's very rare in accounting. We normally use historical cost to record asset values. And even if the value changes many, many times over the years, that historical cost remains as what is kept on the balance sheet. Now, here's some example journal entries from these little exercises I pulled from Openstax. So this is EA 20, 2 transactions. It's asking you to make journal entries to record these 2 transactions. January 22nd was this entry A. We purchased an asset called merchandise inventory in the amount of $2,800. So this is just where we bought some inventory. We're going to resell it later. We're going to put the account name merchandise inventory flush with the left because it's the debit entry. Then we're going to enter the debit column 2,800. Then we'll go to the credit and put accounts payable for 2,800 under the credit column. Notice how we indented slightly to put the account name, and the credit entry is indented to the right of the debit entry in the amount columns. So look at it again. The thing that happened is merchandise inventory was bought. Inventory is an asset and it increased. So we recorded it with a line that shows a debit for an increase in an asset. Then the accounts payable account is the amount we're going to pay later to the customer. It's a credit entry because it's a liability that's increasing. So that's how you record the whole transaction right here. The next thing that happened is we paid the creditor part of that balance, $1,600, in February. So when we pay the creditor part of it back, we're going to record that transaction with a debit to the accounts payable account because it's reducing the amount we owe to that customer. So we're reducing accounts payable. It's a normal credit balance account. So we're debiting the account by $1,600. Then the other thing we know is we're paying out cash. So when you increase your cash, you debit the account. When you decrease it, you credit. And that's why we're crediting cash for $1,600. Excuse me. Okay, here's another one. This one has 3 transactions that are happening. Take a minute and try them. Okay, this one is on March 1st, purchase land for cash. So we increased land and we decreased cash. So we debit the land and we credit cash. Second part, we purchased merchandise inventory on account. So we increase merchandise inventory and we increase accounts payable. If it says on account, it means you didn't pay for it right now. If it says you bought something on account, you didn't pay for it now. And then the third thing that happened, we sold merchandise to customers for cash. So if we get cash for something, we're increasing cash. We debit cash, we credit sales revenue for $555. Okay, so you just have to kind of get used to what we're doing. All right, here they want us to post the November transaction to the T accounts for accounts payable and inventory. So we have these little T accounts we built down here for accounts payable and for inventory. We're indicating the ending balance, assuming these accounts didn't have any beginning balances. We purchased merchandise inventory on account. So that means we had, the best way to do this is to actually make the journal entries. So on my sheet, I just jotted down the entry right here beside the description. So that would have been a debit to inventory and a credit to accounts payable, right? And then the B transaction, we paid the vendors for part of the inventory we purchased earlier in the month, $14,000. So we don't record the inventory again. We just record the payment we made. So if we reduce the accounts payable, that's the B transaction. And then the C transaction, we purchased merchandise inventory for cash, $6,500. So that increased inventory again, but it didn't change accounts payable. So if those 3 transactions happen, in order to record it all, we would have had to have the cash account too, because that cash was involved in transaction A and B. I'm sorry, B and C. So now we can come up with what is the ending balance of each of these accounts just by tallying them up. Accounts payable had a credit entry of $22,000 and then a debit of $14,000. So that brought them to a net balance of $8,000. $22,000 credit. When you put a debit with that of $14,000, it eats up part of the credit balance, leaving you with just $8,000 remaining in accounts payable. So it's just logic, really. It just means we still owe them $8,000. We owed them 22, but now we paid 14, so we only have 8 left we have to pay them. And then the inventory account had 2 entries of purchasing inventory. So both of them were debits, a $22,000 debit and a $6,500 debit for a total inventory investment that we have now of $28,500. So what you're doing is you're just getting used to how to tally up what the ending balance of these T accounts is, because it's just recording every transaction that happened regarding that account. So you can see what is the net effect of that account. So what is the ending balance, basically? And so if you have 2 debits posted, it's just going to make a bigger debit. When you have a $22,000 debit for inventory and you add another debit to it, you're just making a bigger debit. But if you add a debit to a credit balance account, you're reducing that balance because it's that debit ate up some of your credit balance, right? Okay, now the next one, it wants journal entries on November 19th for a purchase of inventory on account, $12,000. So you're increasing the asset, you're increasing the payable. Then it wants a pay the creditor $10,000. So that's just when you pay something, your cash account's going to be credited. And also when you decrease an accounts payable, it's going to be a debit because accounts payable is a credit balance account normally. Okay. This is just a practice. We're just getting very comfortable. There's 3 entries we're going to make regarding issuing stock, buying supplies on account, and paying a cash dividend. Issuing stock every time is going to be a debit to cash, credit to common stock. Could be capital stock too. The next one is purchasing supplies on account. So it would be debiting the supplies account because it's increasing an asset, and it would be crediting the accounts payable, increasing a liability. The third one is paid cash dividend to shareholders. Dividends always recorded with a debit because it's decreasing equity, right? And then, oh, sorry, I'll do them together. And then we paid something. So our cash account decreased, that would be a credit. All right, now let's see, we got this one. And we just got a few more after that. This is recording them in the T accounts again. And again, the best way to do it is just just jot down the journal entry so you can see where you would have posted it. If we sold products to customers for $8,500, for cash, it would increase our cash account. If we sold products to customers on account, it would increase our accounts receivable. And normally accounts receivable and cash would have a beginning balance, but this problem told us it did not have a beginning balance. So that's, see right here, that's why we don't have a beginning balance listed there. Then the third thing that happened is we collected cash from customer accounts. That means we did not make a new sale. We just collected some of the cash we had sold earlier and recorded as accounts receivable. So that means we increased cash with a debit and we decreased our accounts receivable, which is a credit. So you could do the journal entries and it would eliminate all the confusion, because if you have the journal entries, you can just post them to the T accounts rather than having to reconstruct and think, how did this all pan out and affect the cash account and the receivables account? So to tally them again, if you have 2 debits, you add them up and that's just a bigger debit. If you had 2 credits, you would just add them up and that would be a bigger credit. But if you have one of each or multiples of each debits and credits, then you net them out and you put them on the side of the largest balance. Because every time you have a balance in an account, if you do a contra entry to it, it's just going to reduce or eat up part of that balance. This has a debit balance of $2,900, and when you paid the $1,600, that ate up some of the balance so that it's only $1,300 remaining. This one is issuing stock and buying some equipment. Issuing stock is just a debit to cash and a credit to common stock. And then buying equipment is debiting the equipment, which is an asset, and crediting cash, which is equipment, which is an asset. And then they wanted you to post what that transaction did to the cash account. So we're just going to post it. We would debit cash for $2,500 for transaction A, and we would credit cash for $16,000 for transaction B. And this one had the little gotcha right here where they gave you a beginning balance. So we had to enter that in our T account if they give it to you. So since they gave me that $16,333 beginning balance, I had to enter that as my beginning cash. And then I post my 2 entries. So now I have 2 debit entries, $16,333 and $25,000. So that is what, $41,333. And then after that, I had a credit of $16,000. So I net these 3 together and I come up with $41,333 minus $16,000. So my ending balance of cash is the net of these 3 transactions. So it's debits. The debits are larger than the credits, so I know it's going to be an ending debit balance. Also, the other way of thinking of it is by the time you did these first 2 entries, you had a $41,333 debit balance, and that $16,000 credit ate up some of your cash balance so that you were only left with $25,333. All right, now PA 15 is another one where they're showing, I just have a lot of extra ones and I'm going through pretty quick because it's just practice for you. Purchase an asset on account of merchandise inventory on account. You know what to do with that. Debit the inventory, credit the payable. Then we paid a creditor. If we paid them, that means we're going to credit cash. You do the part you know first, and then you let the other fall around. If you're doing a journal entry for me on a test, then if you get the amounts right, you got half the credit. And then if you get cash, the direction cash went right, you got 3/4 of the credit too. Then all you have to do is figure out what is the debit. If we pay creditor, oh yeah, it's got to be accounts payable. All right, so then they want you to post these transactions to accounts payable, and they are telling you that accounts payable has a beginning balance of $5,000. So we're going to start with $5,000, and we're going to post. I'm going to get it eventually. We're going to post. It's just not showing up. I'm sorry. Oh, you know what? It's not a debit. Accounts payable is a credit balance account. You silly girl. Okay, so I start with that. And then I post the first transaction, which is a credit of $30,000. Then I post the second transaction, which is a debit of $12,000. So now I'm trying to figure out what my ending balance of accounts payable is. I have $35,000 credit, a $5,000 and a $30,000. So a total $35,000 credit. I know it's going to be a credit balance because that's more than the debits that were made to the account. And accounts payable is a normal balance of credit. So you're expecting it to wind up being its normal balance. $35,000 credit to accounts payable minus a $12,000 debit. The debit eats up part of my credit balance, leaving me with just $23,000. I had $35,000 in credits and $12,000 in debits. That's a net $23,000, and it's a credit because that's where the biggest part of the entries were, the amount of the entries. And I confirmed that, yes, that's reasonable because accounts payable, it has a normal credit balance. All right, here's a couple more. We collected the balance due from customers of $16,000. So if it says collected, that means you're going to debit cash. You're going to credit the accounts receivable because we got it from our customers on account. Then on June 10th, we purchased supplies for cash. Supplies is an asset account. We debit that asset for $44.44 and we credit cash. So then they ask you to do the T account for cash, assuming a beginning balance of $37.4. So on 37.4 is the beginning, and then the first entry was a debit of 16,000. Second entry was a credit of 44. So I can tell you what the ending balance is by adding my debits, 37.4 and 16,000, and then subtracting that credit, bringing me to an ending cash balance of 48,956, which is a debit. The way I know, there's two ways. Cash normally has a debit balance because that's its normal balance. If you get a credit balance in your cash account, it means you're overdrawn at the bank. And also, I obviously know it's correct because the two entries to my account that are big are the debits. That debit balance is going to be the ruler. So those two debits added together minus the credit, because that 4444 ate up part of my cash balance, leaving me with only 48,956. One more. This is the last one for this one. We're going to do these journal entries that record merchandise purchase, debit the merchandise account, credit accounts payable. Then we're going to record paying part of that balance. So a lot of these are the same entries that we made earlier. 11,350. Not some of that balance, some of a lot of balances, I guess, from other creditors too. Then accounts payable. They give us a beginning balance. When they tell us the beginning balance, they didn't say it has a credit balance, did they? Because they think you know what the normal balance of that account is. So when you post it, you just have to know the credit balance is what accounts payable would have, unless they spoke otherwise. If it didn't have a normal balance, they would say it has a debit balance. All right, so we're going to record the two entries to accounts payable, a $9,200 credit and an $11,350 debit, which means now we can net the accounts payable balance. A credit of $7,500 plus a credit of $9,200 is $16,700. And then we debited it by $11,350, leaving us with an ending balance of $5,350. And that's our ending balance of accounts payable. It's a credit balance because these credits were higher than the debit amount. And it makes sense because accounts payable is supposed to be a credit balance account. That's its normal balance because it's a liability account. There's my reference of the link to Openstax, and we're pulling from chapter 3 for these exercises. So that's it. We'll do some more exercises from the textbook, our textbook, and also we'll be back with another chapter. Yes.